The market is currently navigating a period of significant structural tension. Core inflation's persistence is now clashing with a rapid unwinding of geopolitical risk premiums. The baseline performance for the week shows a defensive posture among the major averages. The Dow Jones rose 0.66% to 51,202. The S&P 500 index added 0.65% to 7,431, and the Nasdaq gained 0.7%, closing at 25,888. While large-cap indices remained stagnant, the small-cap Russell 2000 outperformed significantly, rising 3.9% to 2,943. This rotation was supported by dropping volatility. The VIX plunged 18%, while the 10-year yield moderated to 4.49%. Commodity and currency markets were equally volatile. While the dollar and yen were flat, energy prices saw a total retreat. WTI fell 7.6%, and Brent crude dropped 8%, while gold futures saw a nearly 3% decline. Bitcoin diverged from the broader commodity sell-off, managing a modest 1% gain to reach 63,484. While major indices closed within a narrow range, headline figures mask significant internal churn as global assets revalue against shifting liquidity constraints. Much of that internal disruption can be traced to Friday's dual listing of SpaceX, an event that acted as a massive vacuum for market liquidity. The initial offering was priced at $135, but surged 19% on its very first day to close at $160.95. It generated over $84 billion in volume, fueled by single $5 billion institutional orders and over $100 billion in retail interest. To participate in this IPO, active funds had to liquidate existing positions. This chart visualizes the Liquidities app, the process where capital was pulled from established tech leaders to fund this new allocation, creating a period of forced rebalancing. This coincided with growing anxiety over AI infrastructure costs, Supermicro's $7 billion dilution, and Oracle's $40 billion debt issuance weighed heavily on the sector, with Oracle shares dropping 8.5%. We are also seeing a rising execution risk premium. Even with record earnings, Adobe shares fell 6.6% after their CFO's sudden departure, demonstrating the market's lack of patience for management uncertainty. On the trading floor, this has translated into extreme sensitivity regarding capital expenditures. Companies are being judged not just on AI potential, but on the cost of building it. The Liquidities app shows that high beta tech valuations remain vulnerable. Without clear evidence of operational efficiency, even the most prominent leaders face immediate selling pressure. These microshocks are occurring as the broader macroeconomic data shows signs of stagflation. Headline CPI has accelerated to a 3-year high of 4.2%, while producer prices jumped 1.1% in May alone. Labor costs drive this stickiness. Total compensation reached $49.32 per hour, with benefits accounting for 30%. This rigid cost structure pressures consumers. Delinquency probabilities climbed to 12.6%, and 48% of Americans report worsening financial conditions since early 2023. To address this, Fed Chair Kevin Warsh is expected to pivot toward an opaque policy framework. For the upcoming June meeting, the Fed is considering removing the easing bias from its statement and potentially ending the use of the dot plot. Energy markets also reacted to headline risk. The loss of a U.S. Apache helicopter pushed Brent crude prices toward $98 a barrel. However, by Friday, news of a potential ceasefire saw those gains vanish, with Brent crude falling 4% to $86.71. While energy risks fluctuated, technology risks expanded into the regulatory sphere. The administration's recent directive to take down Anthropic's Fable and Mythos models signals a new, more restrictive era for AI model exports. With the Fed potentially moving toward a less transparent model and consumer spending capacity diminishing, market direction is increasingly being set by these sudden geopolitical and regulatory shifts. A chronological review of the week shows how specific news events dictated capital flows. On Monday morning, a tactical alliance between NVIDIA and SK Hynix in Seoul helped stabilize global semiconductor sentiment after a sharp sell-off in the South Korean market. By Monday afternoon, the healthcare sector shifted, following Eli Lilly's clinical data, which showed their oral treatment, Foundayo, outperforming its primary competitor in efficacy. The week's low point arrived on Wednesday. As this timeline shows, the combination of high CPI data and the massive super micro dilution caused the Nasdaq to drop nearly 2% in a single day. The recovery was just as sudden. On Thursday, as Middle East tensions appeared to cool and the 10-year yield fell to 4.46%, the Dow Jones staged a 930-point rally. The week concluded with the SpaceX listing on Friday. The company reached a $2.1 trillion valuation, creating enough momentum in the space sector to pull Rocket Lab into the Nasdaq 100. Looking toward mid-June, the primary catalysts will be the Federal Reserve's strategy shift, the status of energy supply agreements, and the continued impact of AI export restrictions on hardware manufacturers. This sequence of events demonstrates how sensitive current valuations have become to binary news triggers, making tactical scenario planning a necessity for navigating these specific liquidity shifts. We can model the week ahead through three primary scenarios. For the Dow Jones, a bull case of 52,000 depends on oil falling below $80. Conversely, a bear case of 52,200 becomes likely if oil returns to $95, while volatility spikes. The base case for the Dow is a range between 50,800 and 51,500, defined by a continued rotation into defensive sectors like financials and materials ahead of the Fed meeting. For the S&P 500, a bull target of 7,550 would require a recovery in software valuations. The base case holds between 73,500 and 74,500, as lower energy costs are offset by the reality of sticky wage inflation. The S&P bear case of 7,200 would likely be triggered by further equity dilutions or the 10-year yield rising above 4.6%. The Nasdaq's bull case of 26,300 is contingent on hardware giants proving that export controls won't impact their immediate shipping volumes, potentially triggering a short squeeze. The Nasdaq's base case sits between 25,300 and 26,000, while a bear case of 24,800 could materialize if pre-IPO selling intensifies or regulatory restrictions broaden. These narrow ranges suggest the market is at a fragile inflection point, where even minor macro shifts can force prices out of their current base case zones. In this environment, the most resilient assets are those with demand inelasticity, companies that control critical infrastructure or healthcare needs so vital that customers will pay almost any price to secure them. NVIDIA remains the primary example. They hold an 80% monopoly on discrete GPUs, and have effectively used their supply chain dominance to create a hardware barrier that makes their AI ecosystem difficult for any competitor to breach. Technically, NVIDIA is approaching a potential entry point at $205.19, which sits just below its 50-day moving average. A defensive stop loss can be placed at $189.26, the 200-day average, with a medium-term target of $260 as new chip architectures begin to ship. This defensive profile is mirrored in the metabolic health sector. Eli Lilly's new oral treatment, Foundayo, removes significant barriers to patient use by providing a once-daily formula that isn't restricted by food or water intake. The technical setup for Eli Lilly involves scaling into the position between $1,133 and $1,100. With its 50-day moving average providing support, a stop loss at $1,020 targets a move toward $1,350 as the metabolic market expands. While these companies operate in different industries, they both provide essential components of the modern economy. This makes their revenue streams highly resistant to the broader inflationary pressures impacting the average consumer. Micron technology represents the physical bottleneck in this high-performance computing chain. As the primary provider of HBM3E and HBM4 memory, it stands as a direct beneficiary of the current structural shortage in high-bandwidth components. The technical data shows significant short interest accumulating in the stock. On this chart, you can see that high volume and recent price action have positioned Micron for a potential squeeze as memory pricing continues to rise. The entry strategy centers around $981.61, supported by the 50-day average. A stop loss at $880, below the recent low, provides a clear risk boundary for a target of $1,200. In an environment defined by limited Fed guidance and persistent cost pressures, risk management involves concentrating capital in the few entities that possess genuine pricing power. Broad market exposure faces significant headwinds, but these specific infrastructure leaders remain structurally advantaged. For more deep dive U.S. stock and market analysis, remember to like, subscribe, and share Calling Monster Finance.